Welcome to the Innovators and Investors Podcast. I'm Kristian Marquez, founder and CEO of Finstrat Management. At Finstrat, we provide CFO-led accounting, finance, and reporting services to assist clients monetize their business. Stick around to the end of the podcast and I'll share how you can be our next guest. Now on to the show. Hello, and welcome to another episode of the Innovators and Investors Podcast. I'm your host, Kristian Marquez, founder and CEO of Finstrat Management. Super excited because with us today we have Andy Galpin. Andy is the founder of Tree and Leaf Partners. Andy, welcome to the podcast.
Thanks so much, Kristian. It's a real pleasure to be with you.
Glad to have you. So let's start with Tree and Leaf Partners. Love to hear about the firm and your focus.
Yeah, so Tree and Leaf Partners is a redemptive acquisition fund. I like to describe myself as a redemptive acquisition entrepreneur. And what I mean by that is I'm an entrepreneur because I'm going to be stepping into a business and leading and running and helping it grow and scale into the future. I'm an acquisition entrepreneur because I'm looking for an existing company to step into and help build out the future vision of that organization rather than just start something from scratch. That is a very kind of unique skill set. It's something that I know I don't have, but I'm really excited about growing and scaling companies. So that's where I really lend value and bring value to a process. And then finally, redemptive, because I like to look at a business as a vehicle to drive change within society. A business is the hub of an ecosystem. It interacts with not just customers, but suppliers, the community, the employees, and everyone who's part of that broader ecosystem that helps deliver that value and solve a problem for society. So if we think about it as a broader ecosystem, we can be intentional about how do we make that ecosystem better for everyone rather than just better for ourselves.
So a whole bunch of things to unpack. Would love to hear if there are any industries in particular that you're focused on that you think that lend themselves to positive change.
Yeah, I think every industry has the potential to drive impact. We focus on two kind of core industries that are already very naturally purpose-driven, the education and the healthcare sector. We do that primarily because we like to do a very simple test to see whether a business is solving a real problem in the world. And that's easy to do in those two sectors. In the healthcare space, we're asking the business kind of how does it contribute towards a better outcome to patients? Even if they're not directly interacting with patients, they're 4 or 5 steps removed. Maybe they're a technology provider. I know that's your background, Kristian. You're not working directly with the patients, but you are facilitating a process that helps better outcomes for patients. And the same thing happens in the education system. We should be able to connect the work that someone's doing in that space for helping people gain new skills that help them progress in their career and life. So we like to work in those two sectors. And then I also like to bring in my background and my expertise that not only is in the growth and scaling space, but is in the technology space and in that ecosystem. So I spent 6 years at IBM helping our clients design more meaningful experiences for their customers and employees. So I like to bring that customer experience strategy lens to the table. And that often lends itself better to more technology forward companies or software driven business models.
Okay. And so within the ed and health tech spaces, what's a profile for a company that you find appealing?
Yeah, typical kind of size, that kind of profile. And yeah,
Yes.
so we have kind of financial metrics and numeric ways that we evaluate companies, as everyone does. But we also like to look at the culture and the people aspect of an organization as well. But on a software side, we look at companies 4 to 8 million in annual recurring revenue. We look for them to be past that initial product market fit stage. I would describe that as the 0 to 1 stage of a founder, someone who's identified a real problem in the world and has built a solution and validated that solution is actually solving a problem. And it's now ready to scale and increase the impact that it's having. So we pick it up when it's ready to scale or when it started the beginning of that scaling journey rather than earlier in the process. So often they're not as fast growing as a VC company because we're not in VC ourselves. We look for more kind of steady, consistent growth in a market that has a lot of potential to grow and build out. And then we look for a founder that either wants to focus their time and energy on building the product rather than running the company, or they're interested in going back to that 0 to 1 stage and they've got a new idea that they're ready and excited about pursuing.
Oh boy, a whole bunch more to unpack. So notwithstanding annual reoccurring revenue, would love to hear what other metrics that you'll focus on.
Yeah, so we look at a lot of the typical metrics that a VC firm would look at. We look at customer acquisition cost, lifetime value of customers, how long it takes to run that cycle, the team within the organization. The big challenge I find with kind of some of the startups that we look up and some of those more early stage is they haven't built the infrastructure that actually allows the company to emerge as a business versus just a hobby that someone else is running. And they can be driving a very high level of revenue, but if there's three people in the organization and two of them want to leave when the acquisition closes, they haven't really built a company that's going to be sustainable in the long term because they haven't got those systems and processes and people around them that are helping run that organization. So we'll do a bit of a deep dive into the organization and how it's structured, any gaps within that space as well. And then we'll look at profitability is another measurement that we tend to focus on, which is a little bit different to VCs. I know we've turned the tide a little bit in the VC world that profitability has become more important. We don't invest in companies that haven't broken even and can't demonstrate a clear path to growing that profitable side of the business. But we look for kind of 10 to 20% EBITDA margins on these companies as well to complement some level of growth. And we'll evaluate that based on how fast it's growing and whether all that money is being reinvested in the growth of the business and could be balanced out between profitability and growth. Because that's always the tension that kind of founders wrestling with. How fast do I grow? Whether I kind of bank some of those profits and return some money to investors. And we take a bit more of a balanced approach to that.
Okay. And then as far as yardsticks, I'd love really curious to hear your perspective on yardstick for product market fit. A lot of
Mm-hmm.
different definitions out there. You could be as objective as just saying, hey, show me your revenue and what's the clip that it's growing, but how do you look at it?
Yeah, we probably look at it in really simplistic terms. We look at revenue and how fast it's growing, and then we look at churn. So if revenue is growing fast, we're bringing on new customers. They seem to like the idea. There's a very obvious problem it's solving. But then after a year, all the customers are churning at the other end. It probably suggests that we found the right problem, but we haven't necessarily found the right solution to that problem because customers are going elsewhere or it's not delivering the value that we think it is. If they're getting both of those, the company's growing and we're not losing lots of customers at the end of those contracts, then it suggests we've found the right balance of kind of maturity to pass that product market fit stage and be ready to start scaling what we're doing.
And retention is one thing, new sales are another, but one of the biggest challenges that I find as founders look to scale their company is like how do you continue to sustain meaningful growth numbers at scale? And
Yeah.
so what are your expectations? Are you prepared to revamp their sales and marketing effort? I know there are private equity firms like Vista out there who have their own playbook when they make an acquisition. Love to hear how you think about growing top line.
Yeah, it starts for us from a period of understanding what's working well and what's not working with that company. If we're buying something and it's already growing very fast, then we prefer not to break things that are working really well, but we'll look at it and we'll bring some expertise in to determine is this structure the right structure to be sustainable in the long term? And a lot of that tends to revolve around the founder and how involved in sales they are and how much they're leading that. Because as a company grows, that founder only has certain amount of capacity. So they often reach a point where they become the bottleneck in that sales process or in other parts of the organization that is preventing the organization from scaling. So we want to put some infrastructure and some people around them to allow the founder to step out of that role, whether they are going to continue with the company in the long term or whether they're going to transition out. That's a really important transition point to make. And then we get a better understanding of what does the steady state look like for that company with their existing setup and what things do we perhaps need to tweak or change to adjust how we're going to market.
It's interesting, this concept of founder-led sales. And I think for a lot of the founders in the audience who obviously have a hand not only building the product, but making sure that new clients are coming in the door, maybe not appreciate that. You really should be thinking about how do you start to build a team around you so that you can start leveling up from a growth perspective. Obviously, very big emphasis on artificial intelligence since OpenAI released ChatGPT now almost 2 years ago. Would love to hear to the extent that AI is factoring into your acquisition plans.
Yeah, we use it in our process in terms of speeding up some of the more administrative parts of acquiring and analyzing a company. So we'll often lean on it to analyze industry information or give us some feedback on the initial portfolio of information that we get from a broker or an investment banker as part of that process, or a kind of business owner that we're working with as part of that process. But it's been really interesting to see AI, I think, has a big impact on how a company operates, even if it doesn't impact the product or service that a company is offering. And I think we're still at the kind of the precipice of that hype curve for AI, where there's lots of great ideas and we're like, there's lots of potential here, but we haven't necessarily seen a lot of value outside of automating some of those more mundane administrative tasks that we see in a day-to-day basis. So we like to see companies leveraging AI to take some of that workload off their employees so they can focus on doing what they really enjoy about their job, which is probably not writing notes on a call. Now, we can very easily bring in AI to help with that and speed up some of that process and document those sales calls and capture those leads as part of the process. But I read a recent interview with a CEO who was using AI for kind of sales development representatives. And they said, I've never had a bigger pipeline, but I've also never closed any of those deals. So there's a lot of kind of cloudiness in terms of the value that AI is delivering and where in the value chain it can deliver the most value. Because it's very clear if we want to reach the maximum amount of people, we can use AI to scale up very quickly. But I think the evidence is a bit hazy at the moment. That scale is actually converting into new sales for the business in the way that adding a new human SDR would to that process. So I think there's still a lot of work to be done in that stage, but there's definitely places in the organization that we see that value added from an operations side outside of kind of core product functionality in a product that's been offered.
And so on that note, you're in a really unique position, and so much is that you're seeing a lot of companies. And so it sounds like it's fair to say that monetizing AI is the exception.
I would say so. Yeah. A lot of the companies I see that are using AI in their core product are, I would call it cheating a little bit. They just integrate with the OpenAI API, and they're not doing much really innovative inside the product with that AI, but they are using it so they can say they can use it because it's a good box to tick on the marketing front. But that reflects the types of companies we tend to look at that don't tend to be in the fast growing AI unicorn space. So I will caveat it a little with that. They're focused more on their core functionality that they're delivering to customers, and they're more exploring what AI looks like, and perhaps don't have internal to their teams AI resources and kind of data scientists that can really help them understand how to add value using AI to the products that they offer to their customers.
Got it. It makes sense. I agree. We're still probably in the first or second innings of the development of AI. And my sense is that it is the holy grail of being able to not only use it from an admin function, but being able to monetize it as a standalone or a core part of your offering. We could change gears a little bit. Would love to hear how you arrived at the point of Tea and Leaf, and any color that you can give on how you generated the capital to be in a position to make your acquisition.
Yeah, so I started my career at IBM, as I alluded to earlier, and I really loved the work that I did. I loved solving problems for customers. I loved moving between different clients and helping them solve different problems in different areas of their business. But as a third-party advisor, there's only so much influence you can have in an organization. You can give advice until you're blue in the face, but the client has to both accept the advice, and even if they accept the advice, they have to actually do something about it to implement change in that organization. I had a bit of a challenge of a lack of ownership and accountability of some of the things that I was recommending because I wasn't in the position to actually make those changes in the organization. So that was my pivot out of the consulting world, and I on a path to find something else that would allow me to have my cake and eat it by keeping all the things I really loved about the consulting world, but giving me this element of ownership and kind of accountability of what I was doing and the results that I was delivering on the other side. So I spent 2 years doing an MBA at the Kellogg School of Management at Northwestern in Chicago. And that was a great experience of tapping into lots of different fields and really validating where do my skill sets add the most value and where do I get the most enjoyment around delivering that. And I got introduced to the model of kind of entrepreneurship through acquisition or search funds, which is what Tree and Leaf Partners is, and the idea of raising capital to acquire one business that I could then transition into owning and operating for the foreseeable future. And that was a really good way of taking everything I enjoyed about the work I did in consulting, but bringing in this element of ownership and accountability and really being able to shape an organization into a great place for people to come to work. Because it has become a big conviction of mine that we spend too much time at work to not enjoy what we do. So we should be more intentional about both the career choices that we make and the decisions we make in that space, but also as leaders of organizations, creating workplaces where people enjoy using the skills and gifts that they've got to really add value to the world.
Agreed and said. And if you don't have any objection, but totally understand if you don't want to go into detail, how did you find the conversations? Do you have any limited partners? And how did those conversations go and share this idea of, hey, we're going to go look for a great company to acquire?
Yeah. So the nice thing about the search ecosystem, the model has been around for 30 to 40 years now. So there's an ecosystem of capital providers that has come up within that over the years who are investing in people like me on very similar journeys. I like to think I'm a little bit more unique, focusing on the culture of an organization and trying to create more meaningful places for people to come to work. But one of my investors did exactly that 15 years ago, acquired a software company in Canada and then exited in the last few years and are now on the other side of the table of helping people like me do the same thing and follow in their footsteps. So I had some really great conversations with people like them and other capital providers that are a bit more either redemptive in nature or kind of conscious in how they think about their investments and the broader impact that has. So they've got LPs that are very keen on investing in the right industries that are solving the right problems in the world that are going to make a difference because they have a bit of a philanthropic lens to how they think about capital and investing. So it was a fun journey, but you obviously had to convince people, one, I could find a company and actually close an acquisition, and two, I could actually run that company on the other side. So we had a lot of very interesting conversations with investors talking through my background and how that adds value to the table and the types of companies that would be a good match for me in terms of the skill sets that I had.
Fantastic. So back to ed tech and health tech. So for the benefit of our audience right now, recording, this is late Q4 2024. It's after the presidential elections. Two themes we can talk about. One is the potential for the elimination of the Department of Education.
Mm-hmm.
Would love to hear your take and whether or not what consequences that you see and how that may be influencing how you're looking at ed tech companies.
Mm-hmm. Yeah. It's an interesting prospect. We'll see if something actually comes of it, but I think the private market is very ready to step in and fill any gaps that government leave. I think the challenge with not having as much government oversight, as much of that is a disadvantage. It can be an advantage for kind of private capital providers, but just driving consistency around the education that we want for our children and making sure we hit the kind of minimum level of what's needed in different subject areas. And there are lots of views around what that is. And I think government oversight provides some way of drawing that together. And we've got to think as a private sector how we do that to make sure we retain standards and make sure our children are educated in the right way in the subjects that we think are important for their future and the future growth of the company. But it definitely will open up an opportunity for the private sector to step in and provide more in that space where the vacuum is left from kind of government stepping back and being less involved.
And then on the health tech front, rumors are out there that there could be finally a Republican push to further privatize healthcare in the United States. And the logic being better position patients to see improved outcomes because now you have a bigger emphasis on pay for performance versus fee for service. Would love to hear how that may be factoring into how you're looking at companies.
It will definitely change how we kind of value companies depending on the area they're focused on and how they get paid. If the government is going to be stepping back and we're relying more on private services, then we'd be more concerned around Medicare and Medicaid and how much revenue is coming from the government on that front. The big challenge with having a private healthcare sector is often the most poorest among us, and those who are least able to pay get the least care that they need. So it's how do we maintain that minimum level of service so people can contribute towards the world and be part of the ecosystem without being disadvantaged in that, and then balance that with the needs of a more private healthcare system that tends to prioritize those who can pay more or those who have better insurance. So yeah, it'll be an interesting analysis. It's hard to know how much they'll actually get done. 4 years is not long in government terms to actually drive real change in an organization. So I think we'll know by the midterms whether anything actually is going to change or any kind of initial inklings of what actually is going to come from that.
Yeah, I think the good news is I think the train has left the station, regardless of what the political landscape has in store. And in either event, wish you a tremendous amount of success in finding a great company that's looking to make change. Andy, it's been a great podcast. If there are any founders out there who would love to meet with you and talk, how can they find you?
Yeah, so you can find us on our website, so treeleafpartners.com, or I'm reasonably active on LinkedIn, so Andy D. Galpin. If you just search for me, I'm a redemptive acquisition entrepreneur. And I love talking about organizational change, building culture, and using storytelling in the work that we do. So if that's of interest to any of your listeners, feel free to follow me in LinkedIn as well.
There you go. Andy, thank you so much. Genuinely appreciate your time and your insights, and I wish you all the success in finding and leading a company to do some great and amazing things.
Thanks so much, Kristian. I appreciate your time.
My pleasure. And that's another episode of the Innovators and Investors Podcast. Our audience, thank you for listening. Kristian Marquez here. Thank you so much for listening to the Innovators and Investors Podcast. If you are a successful founder or an investor who would like to be on the podcast, please visit podcast.finstratmgmt.com/podcast-guest. If you've got something out of this interview, please share this episode on social media. If you know someone that would be a great guest, please tag them on social media to let them know about the show and include the hashtag Innovators and Investors. I'd love to see your posts and suggestions. We're regularly putting out new episodes and content. To make sure you catch each new episode, please subscribe to the Innovators and Investors Podcast. And your thumbs up, ratings, and reviews go a long way to help promote the show, and it means a lot to me and my team. Would you like to know more? Go to our website, finstratmgmt.com, or follow us on LinkedIn or on X. Our handle is @finstratmgmt. This is Kristian Marquez. Thank you for listening. Until next time.